All right. Welcome, everyone. So thanks for joining today's webinar on evaluating risks and opportunities with yield products. So really what we want to dive into today is how both like the risks, but also the opportunities and strategies just differ across CeFi and DeFi. So we brought along some of crypto's most notable trading, market making, exchange, infrastructure firms, just to kind of have this discussion with us. So I want to thank Grant, Simon, and Simran for joining us. Before we do a quick round of intros, I'll set a little context for how I think we should structure the discussion. And then maybe we can kind of walk through some backstory and then, have each of you quickly talk about what your firm does and also your personal backgrounds, given how new this space is and how relevant, some of those prior experiences can be. So really what I want to get out of this discussion is talking about three different things. So first, I kind of want to spend a decent amount of time just talking about risk frameworks. So that's, market and asset level risk, understanding, what is the underlying that you're operating around, and how you think about things like macro, how you think about things like the actual tokens themselves, and those opportunities. Also, thinking about protocol risk. So that can really come in two forms. The first being, more of the economic considerations around the protocols you're dealing with in DeFi. And then kind of the latter being around, more security in DeFi. And then comparing that, I guess, with the third bucket being like counterparty risk when you're dealing with CeFi and how that changes and how to kind of balance that risk versus the inherent risk in DeFi. Next, I kind of want to talk a little bit about like capital efficiency and how protocols are evolving, given that while we've seen a lot of blowups in centralized providers, there is still a lot of room and a lot of learnings DeFi protocols have to take from centralized alternatives. So just getting your guys' update on what the state of affairs is there. And then also I want to talk a little bit about, emerging new protocols, the relevance of things like the merge and kind of a more defined, call it risk-free staking yield on kind of your guys' operation. So with that context, I just want to pass it off to each of you to quickly introduce yourselves, and then we can jump right in. So Grant, why don't we start with you?
I think he's muted. Grant,
you're muted.
Sorry about that. Grant Leslie from Bullish. I sit on the Treasury research team. So what's unique about Bullish is we, own all the assets that are on our platform. Obviously, people can come and LP there as well, but it's basically bringing the DeFi experience, a lot of stuff we'll be talking about, to, in a regulated environment, more of a centralized exchange type experience, no gas fees, but still allowing people to, take advantage of some of the things that DeFi offers, like, LPing different assets.
Cool. Simon, you mind going next?
Yeah, sure. Simon Johansson, Jump Crypto. For those of you who don't know, Jump started out in crypto about 7 years ago, primarily just focused on proprietary trading. As the ecosystem has evolved, we've morphed into traders, builders, open source contributors to unique DeFi projects. Don't have a massive yield presence in the same way that maybe some other firms do, but has been an area of focus for us over the years, and spend a lot of time trying to keep our finger on the pulse and manage risk intelligently and watch how the market has evolved.
Simranjeet Singh. I come from GSR's product team. So GSR originally started off as a market maker back in 2013, I want to say, founded by a handful of ex-commodities traders from Goldman. And it has blossomed, I would say, after the boom that we saw in 2020 and 2021, to market makeover for, I want to say, 200 plus protocols on 50 to 60 exchanges, looking at both centralized exchanges or sexes indexes, have a VC presence, and are really looking to partner with protocols at all stages of their life cycle. And really trying to figure out how we can capture structural yield and arbitrage opportunities.
Got it. Thanks, guys. I guess before we kind of kick off the discussion on risk frameworks, I think it's useful to answer a little bit of a more fundamental question around, what is yield and where does it come from in crypto and how that's evolved. So curious if anyone is brave enough to take a stab at that one.
Yeah, I can start on that. So I kind of went through and just made a list of different places yield can come from. And, first you kind of get a little PTSD from the last 2 years of thinking about different projects and how all this was happening. But also kind of trying to remind myself, like, what are kind of if we were to steel man some of these things that were happening over the last 2 years and how they're useful, what do they look like? So I think where you have to start is with like the cold start problem for a lot of these networks. So you want just a simple borrow lend marketplace like Aave or Compound. It's obviously risky to be, the first person into one of these things. So I think there is, a reason to say, hey, if you, are an early player in this, if you come and put your wrapped Bitcoin or ETH in the smart contract to let someone borrow against it, totally unproven product. If you think back to 2019 when this stuff was emerging, it might make sense to give someone ownership of the network and a token that might eventually accrue value for taking on that risk. So I think over time we're going to figure out how to do these things better, and some of that we may even find ourselves in a place where instead of right now it's like I wish I would have sold every token that I was emitted. You might look back and say, man, if I just held on to those tokens, look what they're worth today is kind of the bull case. So then you have actual places where there's real yield, I guess, and that's fees from LPs. When you're providing liquidity in as simple as like Uniswap or Sushi or any other DEX. You supply your assets and you capture a tiny trading fee from each side of the trade, and presumably you're earning enough in fees to offset whatever risks you deem for impermanent loss. Then there's interest for borrow and lending. Again, back in the Aave example, you deposit your assets, someone's going to borrow against it and pay you an interest fee. That's obviously sustainable. These are all over collateralized loans on chain. There are some examples of under collateralized, but simply for now, we'll just stick with the over collateralized ones. There's interest in the form of or yield, I guess, in the form of protocol earnings. So you think about something like Lido or Sushi. That token, once staked, or in the case of Lido, is theoretically accruing fees that the protocol is earning. Could be kind of viewed as yield. More recently, we're starting to see like the idea of selling volatility as a form of yield, which is a little bit confusing, I think. Anytime I see one of these interfaces, I'm like, okay, it's paying, 35% on Sol or on ETH. And then what exactly happens to the price of ETH or Sol that might, impact that APY or, possibly put my principal at risk. Then we have like staking yield on L1s. This, is a little bit controversial. I've seen back and forths even between like Anatoly and Vitalik about how we should be looking at this. Is in the case of like Solana, I think it's pretty obvious that by staking your assets, you're helping the network, but you're not necessarily like accruing a larger share of the network. You're just preventing yourself from being diluted and losing a portion of the network. With ETH, the big promise is that you can stake your assets and, assuming ETH goes deflationary, that you're actually accruing a larger portion of the network over time. Similar to maybe like a an Apple shareholder, when they have buybacks, that you're actually growing your piece of the apple pie. And then lastly, I put what we call Kobe yield, because he wrote a great blog post, Kobe of Crypto Twitter, about yield that is really just stake this asset so that you don't sell the asset. And they're really just like minting new tokens to give to people as a reward for not selling the asset. So it's kind of unclear why that's actually happening, but maybe you could make the case that it reduces, volatility, and that'd be useful. But I think to be seen on that.
Thanks. That's a really comprehensive overview. And, I think that really covers it well from like a DeFi perspective and how protocols have evolved to, I guess, incentivize users to either provide liquidity, not sell, or perform, various network activities like staking. Something I think that's top of mind for a lot of people, just and probably why we're having this discussion comparing DeFi to CeFi, is around the somewhat unsustainable interest rates that a lot of centralized providers were offering, and that's also like a form of yield or being compensated for risk. Simran, just given that you were a trader, or at the very least like involved in trading practices with oil futures and more traditional products, I'm curious just to kind of hear your thoughts on like the efficiency of the crypto markets, given that a lot of that yield is basically just coming from arbitrage opportunities that lenders would lend out to a hedge fund to take advantage of something like the Grayscale discount or Grayscale premium at the time, or like the Kimchi premium at the time. Do those opportunities still exist? Is crypto more efficient, less efficient, and how do you see that impacting kind of centralized lending going forward?
Sure. I was going to say, I feel that it depends on really what venue you look at, right? When you compare the efficiencies of centralized order books versus the fragmentation of DeFi liquidity, I think it naturally presents structural arbitrage opportunities, right? Like with centralized order books, I can, given whatever the order book dynamics are, I can immediately lift offers and hit bids, versus with things like DeFi, I know there's things such as discrete block times that allow me to take advantage of price discrepancies. You can see instances like that with, I think, the GMX exchange that we saw. But even if I just limit myself to centralized venues, thinking of, let's say, spot versus perpetual trades, where you're able to put on funding trades to capture that, and comparing that to staking yields. Or even if I just only consider DeFi, thinking about yield optimization strategies where you have stable coin rebalancing. I think Sommelier, for example, is a great protocol that came out with, I think it's an Aave stablecoin rebalancing strategy, which has outperformed just with statically yield farming any single stablecoin versus dynamically rebalancing, and has outperformed that significantly. And so I think there are structural instances that allow you to capture yield and arbitrage, both if you just limit yourself to CeFi, limit yourself to DeFi. But really, I think the beauty and elegance of it, and people use composability, usually just limited to DeFi and crypto, but I think composability truly is when you combine CeFi and DeFi together and are able to monetize both. I think that's really the elegance of it. But yeah.
Really interesting. I feel like I've heard that word, most often used in describing kind of like monolithic layer one ecosystems, and the ease of kind of reusing assets within one
transaction.
Yeah, exactly. I guess, like, could you comment on how you saw, like, or anyone DeFi sort of develop on Ethereum, and then maybe views on whether you view sort of more modular approaches as having promise, or if you think that's going to always kind of run into some level of a composability issue, if, say, bridging or cross, like in Cosmos, like communication protocols, don't have as kind of natively seamless ability.
Yeah, I can take that one. I mean, I think the ecosystem is still in super early days. So, when Grant was talking about, inflationary token emissions and sort of the Kobe staking model, like, I don't know if in the next market cycle opportunities like that will exist. I think it kind of begs the question of it's almost akin to like securities lending in centralized finance, right? Like, where is the yield from lending that security coming from? Well, you're lending it out because short sellers want to borrow it. And there's sort of this adversarial relationship between the lender and the borrower, and that definitely exists in DeFi, whether that's a lending protocol like Aave or Compound, where maybe you're lending out spot to somebody who wants to sell it, or it's this sort of mysterious staking yield that basically is paying you for getting front run by other people that are selling. I think on the composability front, it's one of the sort of selling points of DeFi, right? Make money programmable, make things interoperable, open, and just generally have a mindset of, perfect competition is good, and so fungibility across ecosystems or across protocols is good. I think the thing that people tend to underweight is that composability in that.
Simon, real quick, your audio seems to be off. I think it's you because.
Let me switch my. Is this better?
Yeah, that's better. Yeah.
Okay. Composability, also implies like composability of risk, right? You have potentially multiple layers of smart contract risk. You have, George mentioned bridging. Maybe you're taking a wrapped asset from one layer one and using it in a different protocol. Like, you're layering on multiple layers of that risk, and I think that sometimes gets underappreciated. Or maybe swept under the rug. People are enticed by a high APY number and they're willing to ignore some of the other risks.
Makes sense. And I guess, Simon, part of it is, assessing opportunities in crypto. You have to be really fast. And so I'm curious to hear more about, in your role, like how you build out some of these frameworks and how that balances. You mentioned APYs. A lot of that is, in a token that is inherently like pretty speculative as well. So how you model out that complete picture of, asset risk times kind of like, the risk of the actual opportunity you're trying to tackle. And then like, how you weigh like other kind of macro risk on top of that. And just, at a high level, what that model looks like, and from there we can dive a little deeper.
Yeah, I mean, I don't think we've figured it out perfectly. I think a lot of it is asking first order questions about, where is the yield coming from? How sustainable is the opportunity? Is this a short-term play versus a long-term opportunity? I think a good analogy is like when perp funding rates, get really high on one side, you don't see a bunch of people go out and put on, a position that says, oh, well, I'm going to be long this perp for a year because, the annualized funding rate is XYZ, right? People understand that sort of the implicit risk, the market risk of having the perp on dwarfs whatever funding, you're going to pay or receive, even over a long period of time. And so we kind of think about, DeFi in a similar vein, where a lot of these opportunities are short-term opportunities. You assume that you're in a somewhat adversarial environment. People have like a farm and dump mentality that's maybe a little bit stronger in a bear market than it is in a bull market. And so it's a lot of like prisoner's dilemma type situations where you have to be thinking about what the other person is going to do. In addition to, again, the smart contract risk, potentially regulatory risk is a bigger thing, I think, on a lot of institutions' radar at the moment. And weighing that against, short-term money market funds or some of the other yield opportunities out there that a couple of years ago were all at zero and now are actually starting to pay real money. I think to the extent that there is mercenary capital that sort of is indifferent between CeFi and DeFi, right now, clearly CeFi is
the more interesting and safer pool to play in. I don't know if there's that many people that are truly allocating capital across those ecosystems. But if you are making a choice, it seems like CeFi is certainly a little bit more appealing or easy to stomach at the moment.
I was gonna say, I think I saw MakerDAO even today, like set aside $500 million to buy into treasuries. And so it's like when you look at the yield opportunities between CeFi and DeFi, to your point, yeah, like it's clearly obvious which one I think is the winner, especially when you have yield compression from the ridiculous yields that you saw in 2020 and 2021 versus where treasuries are offering it now. Yeah.
Yeah, that makes sense. And you mentioned kind of like farm and dump mentality. One other thing that is almost been a meme, at least in the Solana ecosystem, is kind of like the FDV to market cap and, dumping from, early holders. Do you guys utilize like a lot of tools around understanding when supply is coming on the market? How do you guys think about that and factor that in?
I mean, short answer is yes. It's situation dependent. Sometimes like a good example is sort of the curve convex trade. There's times when there's a lot of CVX that gets unlocked onto the market, and I think we've maybe thought that those will present buying opportunities, but they often don't. I don't know if I have maybe a super evolved comment there. I don't know, Simran, if you have anything else to add, but everything's kind of a special snowflake, at least in our eyes. It's not like all this can be reduced to a nice, spreadsheet or decision framework.
Yeah, I don't think there's a pure academic model that you can look at supply issuance per se and say, oh, based off of this might be a good buying opportunity. Because to your point, there's idiosyncratic factors to each and every case. Sometimes you have massive selling pressure ahead of the unlock. Sometimes it has de minimis impact, and looking at what percentage of the supply is actually being released it'll vary so drastically that I think it's hard to come up with a robust, one size fits all framework for all of these things.
Yeah, and I think as much as the market, like, you just have to assume, like all markets, that there was a level of euphoria. If you go back a year, where people could convince themselves that, like, no, I want to hold this token that has a fully diluted valuation of $60 billion, even though it was invented 2 weeks ago. Whereas now, I think there's probably places in the ecosystem where we're going to look back and be like, I could have just been accumulating what was, listed at like 8% yield in a token that's now, actually made it 80% yield because it 10x'd. I think that's the kind of thing that's like tricky when you think of everything in terms of an APY. It's like it doesn't really make sense unless you're immediately selling it. It's like, what's your opinion about the true value of that asset? And and then you can maybe justify putting your the assets you want to hold in there to earn yield in a token you're long-term bullish on.
So that kind of, I guess, implied the example you gave made me think of, Ethereum and moving to proof of stake. And, that's an asset that a lot of people are pretty confident in, that could offer, anywhere from, low mid single digits to kind of double digit yield. What do you guys think is going to be the impact of that on DeFi opportunities? I guess I'll pause the question there, but I have a ton of follow-ups.
Yeah, I'll start on that. I think we still don't really know what, like how big staking derivatives are going to be. I mean, there's definitely a case to be made that staking derivatives are going to become, something like a winner take all or winner take most market. And I can see a future in which staked ETH or most likely staked ETH, whatever, derivative is the winner, becomes, 80% of ETH. And really the only reason you use actual ETH is to, pay gas fees. And maybe that, gets abstracted away and everything's just staked ETH. It's a weird, future to think about, but and then there's also scenarios in which it never really happens that way. And but then it's hard to imagine why someone would would give up 6 or 5, 4 or 5, 6% on on staking their ETH in order to put it in, into Aave or something like that to earn 2 or 3%. Like it'll be interesting to see where that normalizes.
Yeah, it almost like it reminds me of, you'll see stuff priced in like traditional markets as, Treasury plus or something. And it could make, as you're mentioning, other opportunities either seem less substantial or just uncover the actual, risk behind opportunities in like APY that, definitely carry different assumptions. Anyone else have thoughts on that? Otherwise, there were a few other things with what Simon was mentioning I think are worth doubling back to.
I was just going to say, oh, sorry. It's not, I wouldn't consider it like the risk-free rate for crypto. It definitely is like a benchmark rate, if not the benchmark rate. I still wouldn't consider it risk-free. But yeah, just like, people benchmark to the 5-year or the 10-year plus some premium. I think in DeFi, you kind of get that inherently, right? If people are staking ETH, they get a liquid staking derivative back, and then they're using that as collateral to do the next thing. Like they're able to ladder that yield and get that, benchmark rate plus whatever they're then doing with, the kind of next asset. So, yeah, sorry, Simran, I know I cut you off.
Oh no, I was going to say actually something very similar to the tune of like, I think it's hard to come up with a pure enough rationalization why ETH staking yield should be a risk-free rate. You could argue that any sufficiently large proof of stake reward could comprise a risk-free rate, and what makes that better than the lending rate that you get for a stable coin, which is effectively closer to like yield on dollars, right? When you consider true risk-freeness, and it's not really risk-free because you obviously have penalties, slashing risk, smart contracts, all of these things that are embedded. So the risk-free loses the free part of things. But I think if yields get sufficiently high enough, I wouldn't be surprised if you see people try and capture like delta neutral yield strategies where you're just buying or staking ETH and selling forwards against it and trying to leg into yield trades like that, or coming up with more structured products around that.
Got it. That makes sense. And I guess that kind of connects to something I wanted to ask, around ways of either capturing yield or hedging out risk from other opportunities. One thing I've noticed is, at least from my perspective as not too active a trader, the options market doesn't seem that robust. There's really just kind of one main venue. Yet options are a really good tool for kind of hedging and, or, if say you believe there's low volatility, capturing, some spread. Why do you guys think that's the case?
I was going to say, this is actually something I was talking to one of our sales folks about in a very like bullish and positive tone, no pun intended on bullish. But I think it's because when you look at traditional markets and the size of the derivative markets there versus the size of the underlying market, it's orders of magnitude different. And I think that's because derivatives, when you think about the origin of them, they have a fundamental use case, right? Futures and forwards came about as natural hedging instruments because farmers needed to hedge their production, oil producers needed to hedge their production, and consumers needed to hedge their consumption. And so there was a natural use case, and then speculation is obviously the other side of that coin. I think right now you're missing one of the major components, which is the natural use case in crypto for those derivatives, right? I think in most cases people use them as purely speculative instruments, but the natural fundamental use of them in the sense of Bitcoin miners hedging their production, it has started, but I think that the size of that market is perhaps not sufficiently large enough to have sufficiently large volumes and open interest to really allow consolidation of liquidity and growth there. This is really one of the key drivers, I would say. That and perhaps derivative sophistication. I think like it's very easy to say I'm buying a stock or I'm buying a token, but I think the number of people that truly understand what it means to buy a call option or a put option or straddles and strangles and understand what the risk profile looks like there is perhaps not as large as when you think about sophisticated players in traditional finance.
Yeah, I mean, that's the best potential theory I've ever heard as far as why the crypto options market maybe hasn't gotten the traction that we would expect. We were actually just talking about this on the desk this morning, and one of the points raised is like, at least in the US, one of the beauties of the options market is the leverage that's inherent, and the fact that people can still get leverage so easily, in the perpetuals, potentially reduces some of the enthusiasm around options, where naturally you'd expect, spreads to be higher, transaction costs to be higher. Just the fragmentation of liquidity, non-standardization of strikes and expirations, et cetera. And if people can, get 20 or 50x leverage on a perp and basically treat that like I'm either going to get stopped out and I'm going to, lose whatever capital I put up, and that's my premium on the call, or I've got uncapped upside. Granted, it's not the same risk profile, but I think people kind of treat it as almost fungible.
Yeah, I think the place that we might see it is, you kind of think about it like composability of an LP position, and that maybe you're trying to protect yourself against impermanent loss with options. Like once option markets get more efficient, I think that's like part of what we have to see is, it might be a slow march to the point where like, okay, they're efficient or as efficient as we see in CFI or something close to it, where it becomes useful to actually hedge out an LP position or something like that. But we haven't seen something where, that's reasonable yet.
Makes sense. And I'm seeing we have our first question from the audience, and given it's like pretty topical to what we're discussing now, I think it's worth raising. It's given the comments on the importance of derivatives to hedging, do you anticipate growth in interest rate derivatives as hedges to staking positions post-merge? Anyone feel free to take a stab at it.
Definitely, I think the answer is yes. This goes back to, I think, what I was saying earlier, which is if the yield is sufficiently high enough, I wouldn't be surprised if people simply want to minimize the market risk or delta risk of actually holding the Ethereum by selling perps or dated futures against it, and simply lock in a high enough yield. And I think the other area where you're going to see a massive rise in interest rate derivatives in particular is obviously in the borrowing and lending markets, right? I think what's missing right now is very long duration debt and long duration borrowing that you see in traditional finance, where institutions need to, hedge cash flows and have fixed income instruments, not just for the next 6 months or a year, but looking ahead for the next 3 years, 5 years, and longer durations than that. So I wouldn't be surprised as people have both greater risk appetite or yields get divergent enough or attractive enough where people want to lock those in for a sufficiently long period of time.
Yeah, that makes a lot of sense. I feel like the conversation's going here kind of already right now, so I think it's a natural place to kind of tackle some of our second bucket of discussion, which is really around like the evolution of some of the DeFi protocols. I've heard, many of you guys just explaining some of the inherent, I guess, downsides of using some DeFi protocols. Things like impermanent loss come top of mind. How do you see, I guess while we're discussing that, obviously Uniswap has consistently evolved its model. But how do you see kind of protocols reacting and changing, and do you think those sorts of factors are becoming less potent for firms like yourselves?
I'll try to take that one. There's a lot there. Yeah, I think DeFi is evolving. I think the average user of DeFi, the average Uniswap liquidity provider, the average lender into Compound or Aave is getting smarter. People learn from the school of hard knocks, and they realize that impermanent loss is actually pretty permanent. And as the market evolves, both as the products and the protocols get more mature, as well as the participants get more mature, you're seeing people gravitate towards opportunities that are a little bit more, I'll say, like gated. Uni V2 versus V3 is like a good example, probably the best one I can think of just off the top of my head, of that evolution. I'm not sure where the market goes. I certainly don't have a crystal ball. I do think that the the revolution of Uniswap is cool for two reasons. I mean, the obvious, Ethereum block space, how do you trade in a decentralized manner? How the AMM curve and bonding curve works is a really cool innovation that gets talked about a lot. The other thing is being able to just generically generate passive yield on two assets where you're willing to be sort of a liquidity provider and get paid for that in a non-CLOB environment. Is interesting to me coming from a trading background, right? Nobody at a trading firm would ever say, oh yeah, just put in a bid, GTC bid, GTC offer, and, just come back in a year and you could have made money, right? And so that's a really cool innovation that with, even on UniV2, but certainly on V3, like you can put up those assets passively and just sort of forget about it. And come back and have actually made money. Your chances of doing that maybe are certainly not 100%, but there is an opportunity. A stable pair is a good example for that to be like a good, investment or yield opportunity for people.
Yeah, I think the way that I look at it at least is, with like UniV2, there's this long tail of assets where the capital inefficiency of UniV2 like doesn't really matter. In the spreads on trades, like there's not going to be a ton of trading on them. What's cool about it is anything in the world can become an asset, and a tradable asset. And that's like really mind blowing when you think about it. And then I think, when we talk about any of the main, high volume pairs, you already see it where like there's, a lot of the projects I'm seeing right now, I'll name one, just Camino Finance built on top of Orca and Solana, but they're building strategies that you deposit into, and they're just managing a UniV3 position, and rebalancing it according to whatever model they built. So you're kind of like trusting the team that they built a good model, and you kind of use the historical returns of how well it performs. And, and there's going to be a bunch of different, protocols or whatever you want to call them, little startup teams of quants and data analysts doing that and trying to generate the best yield on UniV3. I don't think it's going to be, I think the one place where your average user or even like, a fund that is just positioning their assets is kind of like, we're buyers at this price, we're sellers at this price, and we're going to set our parameters accordingly and just kind of let the market manage that position for us. And unfortunately, we capture some fees, as a little bit of a bonus, but that's not really the main motivation.
And Grant, you mind just quickly kind of walking through, how you guys think about, building out like a hybrid exchange that kind of captures some like, characteristics of an order book, but also, accessing liquidity from AMMs?
Yeah. So, we have right now, we have, like soon we'll have the ability for any company to come in and set in our pools, set different parameters for different positions, and they can set multiple at the same time eventually. And it'll basically just be like a completely UniV3 style like open system for anyone to set liquidity wherever they want. So it's interesting, right? Because at what point does that just start to look like an order book, when you're setting liquidity that way? But I think the interesting thing is that, people have the flexibility to do it either way and develop their own strategies. And we're excited to see what a bunch of, what not only our Bullish Capital entity, but whatever other, firms are LPing on our platform come up with.
Makes sense. And I guess we've seen more recently with more performant layer ones, but also like app specific chains and rollups, teams experimenting with building order books on decentralized infrastructure. So curious what the group thinks are kind of the trade-offs of using that versus order books on a centralized provider versus just going fully the AMM route. I guess for clarity, kind of assuming kind of let's use like the UniV3 model, just so we're not talking about too many different things.
Yeah, I think Grant's point earlier about, anything becoming an asset kind of segues into the commentary around like Uni V3 is probably not going anywhere. Running an order book, whether it's on chain or off chain, is really expensive, and there's a high messaging cost. There's a high infrastructure cost for market makers to get into that business, and if the volumes aren't sufficient, then that CLOB is never going to exist, even off chain in a gasless way. So I think there's always going to be a space for AMMs. I think for more highly traded pairs, we'll see things naturally gravitate towards an order book model, because that's, at least from my perspective, sort of the preferential route for a liquidity provider. And then, the taking flow will obviously migrate to wherever they can get the best execution. And if a CLOB, provides tighter spreads or lower fees, then the execution is naturally going to migrate there. I'm curious if either of you have different opinions or want to disagree with that, but that's kind of how we think about the world. But again, we're maybe a little bit too close to the trading aspect of it, and I'd be curious if anyone else has a different opinion.
No, I mean, I think that's generally, like, I think about it the same way. The one place that, I think you kind of see evidence of like something different than that is entities who are, for whatever, because they're invested in the project or whatever, are providing liquidity in a way that like may not be totally rational as a market maker, but gives their project an advantage in some way of like, hey, we have really great liquidity and build on top of us because of that, or something along those lines, right? There's an ulterior motive.
Yeah, I was gonna say it's always a trade-off between capital efficiency and getting the most bang for your buck. To your point, like when you have larger whale investors or who are like so committed to either a protocol or a venue in particular, I actually think that, obviously allows for dislocations for anyone who wants to capture arbitrage. But as a market maker, you obviously want to think about wherever you're short gamma either way, so you might as well figure out where you can get the most bang for your buck.
And Simran, you mentioned earlier, you brought up in passing recent events with GMX. You mind kind of walking through a little bit about that now, and just maybe more general commentary on like designing DeFi protocols that reference other venues and risks.
Sure. Sure. I was gonna say, well, so I think things operated. I think people have a diverse spectrum of opinions. My personal view is that things operated as exactly as they should have in a market that was designed to operate in that fashion. And it actually even goes back to what you saw during this past summer, where when you think about the failures that happened, it was really centralized institutions acting in a risk imprudent way, while DeFi continued to operate as exactly as it would. And so in the GMX instance that I was discussing earlier last month, it was really someone was able to arbitrage something on a decentralized exchange versus on a centralized exchange because of the, I guess, minimal slippage or no slippage model. And they were able to transact multiple times on AVAX with another pair. And that was because there was no caps on open interest on long or short positions, right? And so this obviously highlights, if you're on the receiving end of that or on the punitive end of that, it obviously highlights smart contract risk. If you're on the taking end of that or the arbitrage end of that, it, I think, just highlights inefficiencies or just arbitrage opportunities that exist simply as a function of relying on price feeds from oracles, which is just another inherent risk that exists whenever you transact in DeFi. Okay.
Yep, makes sense. I guess shifting a little bit, I want to think a little bit more about like day-to-day operations of how you guys navigate this market, and as especially during of course DeFi summer, but also even 2021, when a lot of opportunities were emerging on new chains, a lot of which were non-EVM chains. What was the infrastructure like? And I know there are services that allow you to kind of like keep your keys and provide, walled gardens for you to like access DeFi for certain ecosystems. But I would imagine a lot of infrastructure you guys just have to build in-house if you want to move as quickly as the market. Like what does that look like for you guys, and how much resourcing do you put behind like that tech build?
I think for us, it varies on a case-by-case basis and whatever like the economic opportunity looks like. We have a due diligence and KYC process, which also looks at like what's under the hood. What do we think is the economic opportunity there? If it's already a well-established project or chain, it's really looking at, well, how much volume is trading there, and how much of that do we think we can capture? But to your point, a lot of it is definitely done in-house. There's not a, again, one size fits all solution, and it kind of just goes to fragmentation of opportunity, which comes at a cost, but also provides, I think, a sufficient benefit if you can capture it.
Yeah, I think there's a lot of pieces of infrastructure that have to exist in order for you to have operational efficiency in DeFi. The most obvious one is custody. And like you said, George, there's some providers that kind of offer this walled garden solution. We've built our own custody in-house. We're actually in the process of starting to open source some components of that, with the hope that other people will use it because it will be helpful to them. We didn't really see a slam dunk off-the-shelf product that was really built for, institutional grade custody in terms of, private key security, but also able to support the level of velocity that you need in order to move tokens around, whether that's between centralized exchanges or in and out of smart contracts, or in and out of just, cold storage. The velocity there is really, really important. And I think with a lot of off-the-shelf solutions, they spend a ton of time thinking about security, which is great, but sometimes the SLA to move your tokens can be like 24 hours. And in a market that's quickly moving, if there's an exploit, if there's news, if there's something coming out and you're waiting, 24 hours to move coins, that can be the difference between, getting out unscathed and losing your shirt. So custody is the biggest one. The other thing I'll say, just on the trading infrastructure side, is the technology landscape to interact with a blockchain is very, very different than using a WebSocket or a REST connection to hit a centralized exchange. And so we've got probably somewhere around 10 engineers full time that are focused on building out and managing those gateways, doing production support, troubleshooting. Solana is the best example just because it's sort of new and everybody's heard of it. But when Solana and Serum and some of these novel opportunities came out, like it was really clunky, and even to this day, Solana still struggles sometimes, and it's a different level of sort of hand-holding and support that we're just not used to when it comes to the centralized world. We just kind of take it for granted that these exchanges work and that AWS is up, and that ISPs don't just go dark on you and stop routing TCP traffic. And on chain, like you can't take any of that for granted.
Yeah, that's really interesting. Do you also find there's like a larger learning curve just from an engineering perspective on deploying strategies as code in a smart contract versus something you can iterate, I guess, a little more with a centralized exchange, or have like kind of more like back testing and other areas you can plug that into? Is that a pain point you guys face, or is that at this point?
Definitely. I mean, the sort of Solana example, that Toller and other people have used is like chewing glass, right? And being able to write Rust smart contracts and understand the Solana account model. There is a very, very steep learning curve there. I think there's an equally high, it's maybe a slightly different shape, but an equally high learning curve on Ethereum or any of the other EVM chains, understanding the nuances. Initialization bugs are a good example that have, bitten people in the past and probably will continue to bite them in the future. the winter mute news a couple, I guess, weeks ago now, whatever that was, with the I'll say vanity address. We wish them the best. It's never good to see, a professional competitor that, you think is a really good operator in the space, take a blow like that. But it's sort of the cost of doing business, right? I mean, part of the reason why yields are high and the cost of capital is high, and the opportunity in crypto is high is because, whether implicitly or explicitly, like you're assuming all those other risks that are sort of lower down in the stack.
Yeah, that's a good framework for thinking about it. And Grant, I guess slightly different spin on the question would be, as you guys are, trying to build out a platform, how you think about the ecosystems with the most liquidity versus, prioritizing that long tail and what that trade-off looks like.
Yeah, so we're focused on the high volume trading pairs. And it breaks my heart to say this just because I have my love for DeFi, but when you see something like the Wintermute hack, it just is a reminder of like, okay, what Bullish is doing is smart. It makes a lot of sense. If an actor like that, and Jumps had their situation too, and we don't know how many have happened that we didn't hear about too, because it's not exactly something that a lot of people would be super proud to announce to the ecosystem, and let alone if their business relies on confidence in the market that they didn't just lose a bunch of money. So yeah, I mean it's scary, and I think it's a little bit, it does make sense. As Simon was saying, the yields kind of compensate you for it, in the bull market, and then you look at it now and it's the risk that you're kind of just picking up pennies in front of a steamroller right now on chain, and it's or walking through a minefield, and there's certain parts of the ecosystem that have been well scanned for mines, but then every once in a while we all kind of know that even those could still have some mines in them that we just don't know about, and so it's not for the faint of heart. I mean, I think it's sometimes I'm very surprised at how many assets are on chain earning the yields that they are, and kind of taking, it's almost like once you've been hit by an exploit, then you just become rational. You're like, okay, this is crazy. What was I doing? But if you've never been hit before, it's just kind of like clicking around on the internet, and it's fun and whatever, right?
But we're starting to get into the kind of metaphysical analogies, which is always where a good discussion ends. I think, well, first I want to encourage anyone to ask a question. But while we kind of wait for maybe one or two of those to come in, something, that's on my mind as we discuss ecosystems, and we're also kind of at this crossroads where Ethereum is, really kind of in the swing of developing kind of roll-ups, and some of those are starting to see some traction. Optimism has launched their token. Arbitrum probably will soon. We see a lot of activity still on Solana. Maybe some of that other tail, less activity. But even there was an announcement of a chain. It's SEI. I don't know how to pronounce it. That's trying to solely tackle DeFi. And you have even some of these modular blockchains that have different applications on them that say you can't do on a general purpose chain. How do you guys just and this is a little crystal ball-y, I realize, how do you think that competition or collaboration, call it multi-chain, call it whatever you want, how does that shake out in kind of for the next bull cycle?
All right, I'll start. So I don't know, these are such gut things, and this is just comes from experimenting with different stuff, and I tend to think that Solana is probably going to have the first wow mainstream application. Now what I do and that's that's just a guess. What I think is going to be like surprising, and it's starting to get talked about more and more, is like how fast ZK rollups are coming. And I don't totally like understand it, but I do gather that like once there's a characteristic of ZK rollups that's with scalability, where the more transactions that happen in ZK rollup, you start seeing like lower per transaction costs, which is kind of mind blowing. So I mean, I think like it's the Ethereum roadmap is at a like it's been very rare in the history of Ethereum that it's been surprising how fast things might come, and I think we might have that ahead of us. But I still think there's some strength in the way that Solana does some things, and just the level of like hackathons, and there's some like strength in the level of kind of like centralization that Solana has, where I think that's probably where we see the first mainstream consumer application. I wouldn't bet against like some of the stuff that Multicoin's investing in, and yeah, I mean I'm a believer in the Solana stuff. And then Sui and Aptos too, like a bunch of money's being poured on that, so we'll see.
Yeah, it'll be interesting to see how that shakes out. I think there's, Grant, you mentioned like the Solana meme earlier of, oh, it's these high FDV type tokens. And I do truly think at the time that's what everyone was doing. That was like an interesting way to solve the cold start problem. And now, we're sort of past the cold start problem, and everyone is sort of wearing this outdated tokenomic model that doesn't look particularly enticing from an investor's perspective. So it'll be interesting to see how Aptos or Sui or any of the other new L1s tackle that challenge.
And
I was
Grant,
gonna say it's hard to add to that. Yeah.
Go ahead.
No, I was gonna say it's hard to add to that. I'm very curious to see how, because I do believe that there's been a fair bit of developers who have considered moving from Solana to Aptos and Sui, and obviously, I was gonna say it'll be interesting to see how that shakes out to Simon's earlier point. But
yeah, makes sense. And I guess, Grant, I'll follow up with Dean's question here, which is specifically about the Solana phone. But I think the question can kind of be framed also around if you kind of foresee Solana having that killer app moment, or some feature set. Solana phone to me like signals like retail and like ease of use adoption. Do you think that is the area of growth for Solana, or is it at some more like core foundational or kind of, I guess, added like new type of protocols that can exist, like a order book with CRM? Like where do you see the exponential growth happening on that platform, if not both?
Yeah, I would say like with the phone, one thing is there have been some like obvious kind of like 10x's in crypto. Not investment advice, but I think buying a Solana phone is one of the most obvious 10x's ever, and like the airdrops that will happen with that is, I mean, I just think it's it's a pretty obvious thing to be early to something. Now, I don't think that like it's the chances of the Solana phone really being like disruptive to to any of the major players, obviously the Apple, the elephant in the room, is pretty unlikely. But I think the whole point is to put pressure on those app stores to open the doors to crypto apps and be a little bit more friendly. And I think that's a great strategy, and like someone had to do it, and props to Solana for doing it.
Makes sense. As you said that, I was like Googling Solana phone order. I never thought of like the airdrop opportunity, frankly, but that's an interesting take. I was actually at the Solana store the other day. But I won't go down that rabbit hole. Quickly, I see we have one last question on around regulation. So quickly want to hear if anyone has a view there before we close. Yeah, really the question is around, their route has been going via enforcement rather than kind of being more detailed in providing clarity. I'm trying. Oh, I guess the question is like, how does that, impact adoption or potentially like stifle it? If anyone has a take.
I think it's probably the biggest concerns for institutional players, and it's really the only reason, or perhaps one of the most important reasons, outside of any like capital implications, for why they haven't aggressively entered the space. That said, I'm a firm believer in regulation is just a risk that's embedded in the cost of doing business, and so you have to be mindful of that, and obviously work with regulators and do your best to be transparent about your processes and be beyond reproach. The Howey test is still in use to determine whether something is a security or not. So I'd be very curious to see how that framework evolves as we think about digital assets. But yeah, I think I think once we have better clarity there, I think that's probably going to be one of the biggest drivers for institutional adoption more broadly to the scale that we haven't seen before.
Yeah, I would just add, regulation by enforcement. I think a lot of people view that as sometimes problematic. There's plenty of reason why, the SEC or the CFTC should be enforcing, certain rules and regulations. There's plenty of scams and there's plenty of people out there that have been, taken advantage of. So certainly not all enforcement is bad, but I think the SEC versus Ripple case is a really good example where, if I'm getting my facts right, I think Ripple has actually countersued the SEC for their internal discussions around what is and isn't a security, because, like Simran said, there's this Howey test, but it's not really clear how that's applied. That's a framework from the 1930s related to an orange grove in Florida. It's sort of absurd to apply that same type of framework or same type of thinking to crypto. The world has changed a lot since then. So, certainly regulation, I think, is a good thing, providing clearer guidance and letting, more capital come into the space. I don't know if we're going to get that clarity. I think we're probably going to be in this world where you do something today and 2 years later, you hope that you don't get a slap on the wrist for it. But from an institution's perspective, it's not like anyone is trying to evade the rules or trying to take advantage of other people. You're just trying to operate the best you can in a very, very gray zone, and you don't really know until you have the benefit of hindsight with whether or not what you did was okay.
Yeah, I would just say that it's been sad to watch, and it's not as if we don't have good models. Like everything that Hester Pierce has put out has been, you're just like, yeah, like something like that. And there's even within, once you settled on that, there's a lot of room to debate, but at least you're in the right ballpark of what can move the space forward and be beneficial to consumers. It's tricky, right? I don't really understand the case that we made that airdrops aren't good for consumers. Obviously there's a million things that can happen in DeFi, but some of the ways that this is being characterized or it's almost harmful to consumers that they're the way that they're doing it, because as we saw with UST, if you kind of think back to that time, there wasn't a huge difference as far as the public was concerned about UST versus USDC. And it was the SEC refused to say anything about USDC. And once people are well, not all stable coins are a fraud or whatever, that's oh, maybe this UST thing's good. And that's how, it's it'd be really interesting to see if we had our best and brightest, without political motivations, really trying to make this a safer marketplace and providing information. And that alone is a really hard task. There's so many examples of projects in crypto where like Bitcoin from the beginning, was it a scam, a Ponzi scheme, or was it the future reserve asset for the world? But to have a bear case, bull case, I think is almost the best way to regulate some of this stuff of hey, here's what people are saying, and here's where we're concerned that something bad can unravel and happen. And, I don't think that many people were surprised by the Luna UST meltdown as destructive as it was. Everyone kind of knew that it was super informed that hey, this is a risk, but the upside is, hey, maybe we actually found a solution to the decentralized stablecoin problem, and there's going to be enough Bitcoin to back it eventually or whatever. And, you can convince yourself of crazy things in a bull market. So
I think that's a good place to end it. Simran, Simon, and Grant, I appreciate you guys coming on and also staying. a few minutes extra. So yeah, thanks for joining, and also thanks for all those who joined the call and stayed on a little long. I thought it was really interesting.
Thank you.
Guys, great chatting with you.
Thanks, guys. Cheers.